What is behind the new mediocre of economic growth that is afflicting businesses, banks and policymakers all over the world? And what will it take to snap out of it? This is a question that is set to be asked over and over again during the IMF and World Bank annual meetings taking place this week, and one which HSBC's newly appointed global chief economist, Janet Henry, hopefully has an answer to. So I'm joined here now by Janet. Janet, you are going to fly to Lima tonight, in fact, as we are recording this, to join the IMF annual gathering. You will be speaking at the annual meeting of the IIF, the Institute of International Finance, and you are going to be asked exactly this question. So what's the answer?
It's difficult to answer in very short terms, but I think it's really just the latest wave of the crisis that began before the great global financial crisis, which was obviously a build-up in leverage in developed markets, which they suffered the fallout from. We then saw a series of policies embarked on by global central banks in the developed world. And as we moved into unconventional territory, obviously the main channel of influence was through exchange rates. So while developed markets were dealing with their leverage, it was through weaker exchange rates. And during that period, obviously led by the massive boom that came through in China on the back of fiscal stimulus, but also rapid growth of leverage in emerging markets, that really helped to support some kind of recovery in developed economies. But of course, the build-up in leverage has now come home to roost in emerging markets who've suffered a lot of the currency appreciation, particularly China, of course, who are now facing their own imbalances.
So there is quite a lot that has contributed sadly to the current situation. But the even bigger question is what can be done to kickstart again global growth?
Well, I think so much of the policies that have been embarked upon have been one region or one country taking it in terms to depreciate their exchange rates. So almost exporting their deflationary pressures elsewhere in the world. And arguably this started with the US and the UK, then more recently in Japan, then the ECB QE. And of course, at the moment, we have triggered to some degree by the move in China in early August, but the bigger moves have come through in emerging markets. But all that's simply done is transfer the problem around the world. So assuming that we can't get global policy cooperation anytime soon, which is a nice textbook theory, but I think would be over-optimistic at this stage to deal with it at the global level, I think it's a case of developed markets still having to err on the side of caution. You know, it's interesting, if you look at our forecasts in our latest round, we've lowered our growth forecasts for the emerging world quite significantly, but actually our developed world forecasts have been relatively resilient, particularly our European numbers, which we barely touched at all at the Eurozone level. We downgraded Germany because of the emerging market exposure, but upgraded the consumer story in other parts of the Eurozone. It means that we'll probably see further policy stimulus, monetary policy, more QE for an extended period from the Eurozone. We've already seen the Fed delay because of these global concerns and the impact on US inflation. It's still going to be very difficult for the Fed to become confident about a pickup in inflation despite their tighter labour markets. So it means that the global disinflation problem continues and still further monetary policy. We may see some evidence of looser fiscal policy. Arguably, this is already happening in Europe. There seems to be a greater willingness to accept a little bit more fiscal slippage. And we may, over time, see greater coordination of monetary and fiscal policy.
Okay, which will be a very nice thing to see. So central bankers will remain in the spotlight. But something else that has emerged, and you were talking about decisions being taken at individual countries level, something that indeed has involved many of these countries in a cooperative way, is the announcement of the agreement reached on the Trans-Pacific Partnership, the TPP deal, which is meant to help international trade among 12 countries, including US, Japan, but excluding China at the moment. Are you confident that this may help the international economy in some way?
I think it's definitely a positive, and it should be confidence boosting. And I think particularly for quite a lot of the emerging markets, where since the global financial crisis, they had the big lift from the Chinese investment boom. They had some support from growth in leverage, but we all know that they face a lot of problems. They need a lot of structural reforms need to come through to boost long-term potential growth. So I think what's important about this trade deal, and there's a long way to go, it still needs to get through US Congress. We still need to know where all the exemptions are that come through. It's showing actually it's these kind of mega trade deals aren't over. that maybe we're going to see more of them. We'll see more countries probably join this deal, assuming that it does come through. And all of those kind of policies will boost long-term growth rather than just relying on central banks to do everything regarding monetary policy and allowing another build-up in leverage.
Very well. So we can close this on a slightly positive note. Thank you very much for your comments.
Thank you.